Hello, beautiful people. This is Jessica Jones with Taurus Financial Solutions, coming to you again today with a quick video on index funds and index ETFs. I know I've done a little video on mutual funds versus exchange traded funds, but I get a lot of questions on index funds. So this is not investment advice at all. I'm just trying to help you differentiate between the two. So when you say index fund, it is referring to an index mutual fund. So an index is something like in the market, an S&P 500 is an index, right? It's a group of stocks. Dow Jones Index, there's several different indices that these funds mirror. So, and it's not even mirroring that you're in that particular index. So for example, an index, an S&P 500 index mutual fund is going to be in all of the S&P 500. So when the S&P 500 goes up, your account, that fund is going to go up. It's directly related to that fund, to that index, excuse me. So usually the index mutual funds came into play, I think, in 1976, okay? So they've been around a long time and they were very, very popular, and they still are, because it helps you not be so emotional in your brokerage accounts when you're trading. You're not in any one particular stock, you're in the entire index. So that really helps diversify your portfolio and level out. If one company is totally tanking one week, the rest of them are going to kind of help even it out. Okay, so it's really a popular strategy for long-term growth. The other side to that, which is similar, is an index ETF, or exchange traded fund. It's similar in that it's the same. It'll mirror, or actually you're in the S&P 500 index or the Dow Jones index or whatever index it is. There's just a few slight differences between the mutual fund itself and the ETF. Again, they're both in the index, so it's directly correlated to what the index performance is. However, with a mutual fund, number one, you can only trade it only trades at the end of the day. So you can't trade throughout the day as you can with an ETF. An ETF trades like a stock. You can trade it all throughout the day whenever you want to. Where an ETF, even if you did trade it in the morning, it's not going to close till close of markets that day. So the price can change pretty drastically between, whatever, 10 in the morning and close. So that's one thing. The other couple things are mutual funds are actively managed by a money manager, by a fund manager. So there is going to be more internal costs associated with these kinds of the mutual fund, index mutual fund. Also, with a mutual fund, you can buy a dollar amount. You don't have to buy by the share, which you do with the ETF. You have to buy by the share just like you would a regular stock. And it is more tax advantaged. The ETF is more tax advantaged if you're talking about a non-qualified brokerage account, meaning not an IRA, because mutual funds have to pay out their gains every year to the client, so that is taxable because it has to be paid out. Whereas an ETF, you don't, unless you sell it, you're not going to realize those gains and have to pay taxes on it. So these are just a couple differences. They're both really great in that if you don't want to be an emotional investor, or you need to just balance out some of your pure stock picks, this is a really good way to have a piece of an entire index in your portfolio. And for long-term growth, it is an excellent strategy. They're very low-cost funds, especially the index ETFs have very, very minimal charges inside of them. The mutual funds may have a little bit higher, but if the performance can justify that, then, you know, pay the little fee on it for the management fee in there. This will really help you, especially if you're doing it on your own and you don't have a financial advisor watching your money. This is a great way to diversify for long-term growth. All right, if you have any questions, email me, call me. It's taurusfinancialsolutions.net. I'm Jessica Jones. Thank you so much for listening. Have a wonderful day. Bye.